Now, before we start with today's session, please allow me to introduce our speaker for this evening. I believe many of you already know him and you are very familiar with this speaker as well. He's CY Saw Chun Yen. He's currently the lead trainers for excellence, and he's also a chartered market technician, CMT chartered holder. He has over 11 years of trading experience in local and international stocks and futures trading, and he's also the lead hedging and risk management consultant, which he helps organization in financial risk management and also hedging. His specialty is in trading system and strategies, trading psychology, coaching, and hedging and risk management. So without further ado, I'm going to pass it over to our speaker for this evening, Mr. CY Saw. CY, the stage is yours.
Good evening, everyone. I hope you are all doing well. So today we are going to navigate how to create a solid portfolio with futures trading. Now, did you know that the futures market has a lot of unique features that you can actually take advantage of that, sometimes stock market does not even have. So later, I am going to contrast this to you. So as you may have noticed that the stock market and futures market, both of these markets are entirely different markets, and each of them has its own unique characteristics. However, many people who begin in entering the trading world, they tend to trade almost everything. As long as there is something tradable, they would trade almost everything. However, they do not have a clear reason why do they trade that particular thing, as long as can make money, right? But in fact, as your portfolio, as your trading account slowly grow, you actually need to look at a portfolio, the whole thing as a whole, which is your portfolio. So which is what today we will be discussing, how you can utilize Malaysia futures market to help you enhance your overall portfolio return and also reduce your overall portfolio risk. So whether you are new to futures trading or have years of experience already, I believe this session will help you to stretch your horizon about futures trading, and probably you will find some new ideas and trading strategies that you can use in your trading. And of course, I encourage all of you to take notes and ask questions by the end of the session so that you'll have better understanding of how to create a solid portfolio. Now, before we begin, I want to give a quick disclaimer. This presentation is for educational purposes only, and it's not intended as an investment advice to buy or sell futures contract. So in this presentation, I may be sharing some trading strategies here so that you can understand the potential and the possibilities of how you can use futures trading to build your portfolio. Of course, this is not a substitute for a detailed study or and the development of effective trading methods. You still need to put in some effort on your side to develop strategies that suits your individual needs. And that being said, I hope today's session will help you widen your horizons and expand your knowledge a little bit more about futures trading. So whether you are beginners or an experienced trader, there is always something new to learn, something new to discover, something that you may have not even thought of possible, right? And I'm confident that by the end of this session, you will find some value to the insights that I'm going to share today. So let's get started today. As Ting Ting have already mentioned earlier, my name is Chun Yen. You can just call me CY. So I believe you have already known me for quite some time. So without further ado, let's dive into today's session and explore how you can use a futures market to create a solid portfolio. Today, I will be dividing into 4 key topics that will help you understand how you can build a solid portfolio with futures trading. So the first topic, the unique features of futures market. Now, for the benefit of those who are still relatively new in futures, I will go through some basics of futures so you have a general understanding. Then, starting topic 2 onwards, I will apply all of those basics in practical application so you can see an overview how futures can actually help you create a solid portfolio. Topic 2, the advantages of futures over other trading instruments. Now, this is a frequently asked question by most traders, especially if you are still exploring different types of trading instruments in the market. And sometimes traders are oftentimes confused with these different instruments. So here I'm going to share some comparison with you so that you can actually really better appreciate what futures trading can actually offer to you, because as I have already mentioned, futures trading itself is actually a unique trading product. Thirdly, how to create a portfolio diversification through multi-asset trading using futures. Here I'm going to briefly discuss the concept and importance of diversification and how futures trading can help you create a good diversification as well. And lastly, the 6 unique trading ideas using futures contract. In the final topic, there will be 6 unique trading ideas that are tailored to futures market, and these ideas will help you to as your additional strategy in your trading, in at least in Malaysia market itself, right? So that you are able to enhance your overall returns and reduce your overall risk. So are you ready to take your futures trading to the next level? If you are ready, can you type in yes in the chat box, and we will begin soon. All right, great. Now, before I start, later on, there will be a table that I'm going to share with you, and this is called the asset class correlation map. You can see it's a table, and it seems overwhelming because there are so many numbers and some jargons here. And what does that numbers actually mean? So don't worry about it. It's important for you to understand topic at number 1 until topic 3 first, and then I will go a little bit deeper and comprehensive in my explanation. And then later we will come back to this correlation map, all right? So that you can understand and appreciate the topic for why futures trading can be useful. Now let's start with topic 1, the unique features of futures market. Now, generally speaking, if you look across websites or other reading materials, you will be seeing these 5 major benefits of futures trading. In fact, there are even more benefits from this. So I'm going to share it with you and elaborate further on each and every point in the next few slides. Now, the first benefit, which is, futures, as you know, you can trade both directions. Futures trading is unique because it allows you to profit from both upward and downward price movement in the markets. As you know, you can buy or sell futures contract, and unlike the stock market where you can only make money when the price of stock goes up, futures trading gives you additional opportunity from downward price movements. So for example, let's say if you believe an overall economy is growing and become more stable in the future, so you might decide to take a long position in an index futures, such as the FKLI, which stands for the FPM-KLCI futures. This represents actually a broad cross section of the Malaysia stock market. So if the general market is up, the index would go up. So you take a long position in your index. When the index goes up, you can sell the futures contract for a profit. So similarly, if you believe the FPM KLCI index will go down due to weaknesses in the market, or due to over valuation, or for whatever reason, if you're pessimistic about it, then you can also sell the FKLI contract and profit that way too. Now, besides that, when you trade futures, you won't be facing challenges like you do in the stock market. You don't have to pick individual stocks to invest in. So for those of you who have experience in investing or trading the stock market, I believe you understand that stock picking has never been easy. Even if you have a stock screener, stock picking still remains challenging, because in Bursa Malaysia there are over 1,000 stocks to filter out. Okay, even if you are able to filter out 10 to 30 stocks to invest or even trade, you still need to look individual, all of them, analyze each individual company, their financial strength, the industry, the sector outlook, whether the management for the company is strong, the products and services that is provided by the company. So there are many other fundamental factors for you to look at. So if you agree stock picking is not easy. You can type in agree in the chat box, so that at least it's not only even with stock screener, it's really not easy to pick stocks. Despite you have stock screening for fundamental analysis or stock screening for technical analysis, you still need to pick out quality stocks for investing or even trading, right? So with futures, of course, you can invest in the general broad market. For example, the FKLI futures, it represents a Malaysia general stock market as a whole, and it consists the top 30 market capitalization stocks in Bursa Malaysia. So the cost of entry for you to invest in the whole market, especially in FKLI, is way lower compared to if you invest directly in all of those top 30 market stocks. If you were to invest all of those 30 stocks, right? You just imagine how much would it cost you in terms of a brokerage fee. So if you just only invest in FKLI index futures itself, your cost is actually way lower. And besides the FKLI index futures, you can also choose a range of futures products that cover different asset classes that have good diversification opportunities. A few of the commodity futures such as FCPO, FEPO, and FGLD. So this means you can easily diversify your portfolio and reduce your overall risk exposure. So later on in topic 3, I will share with you about these diversification benefits in detail later. And lastly, in futures trading, it's often simpler than stock picking, as I've mentioned, because it focuses on the macroeconomic factors such as the GDP, the interest rates, inflation, economic growth of a country, rather than looking at individual companies. So when you are able to stay informed about the broader economic picture, right, you can make a more informed decisions about which futures contract and which direction you can actually take position, whether long or short position. So to summarize, futures trading allows you to profit from both upward and downward price movement, and it's relatively easier than the stock market, as you don't need to pick and even filter out individual stocks to invest in. And you can focus on the general market and the macroeconomic factors because it can definitely speed up your decision making in trading. Then the next thing that is which is a good unique feature, which is on the liquidity, which is an important factor for you to consider when it comes to trading and investing, because liquidity refers to how easily you can buy or sell, how easily you can enter and exit the market without causing a significant change in the price. So compared to the stock market, futures trading is highly liquid. This means you can buy and sell futures contract quickly and easily at any time during market hours. So for example, let's say you buy a futures contract for crude palm oil or FKLI, but you need to sell it quickly to raise some cash. So because there are so many buyers and sellers in the futures market, you can find another opposing party who wants to take the opposite position. So which means you can enter and exit the market quite easily and quickly. And unlike stock market, during bad times, especially when the sentiment is weak, when the sentiment everyone is quite bearish, or there are a lot of bad news in the market, generally buyers do not want to get into a particular stock. So if you are a seller, you want to sell your stock, you want to cash out from your stock, it's difficult and challenging for you to get out because you couldn't find any buyer, or you have to sell it at a very low price. So these are the challenges in terms of stock. Now, another advantages of futures trading is that sellers are generally, are not required to own any asset in order to sell futures contract. Now, this makes it easier for traders who engage in shorting the market, where, if you want to sell a futures contract because you anticipate a price decrease, then you can actually take advantage of the futures market, because short selling can be actually a useful strategy for managing risk or even profiting from market downturns. Later, I'm going to explain to you why. And finally, futures trading, it tends to offer a lower transaction cost compared to other trading, because futures trading are standardized, which means it has lower associated fee. So in contrast with other financial products like stocks or bonds, which may have a slightly lower liquidity or higher transaction costs. So for example, if you want to invest in the broad Malaysia stock market, you need to buy all of the top 30 market cap stocks, right? So it's a very high cost to you to do so, and it incur high transaction costs. So one simple way for you to enter, have exposure with the general Malaysian market is actually take a position in the FKLI index futures. So to summarize, futures trading, it's highly liquid, which makes it easy for you to buy and sell contracts quickly and effectively. Thirdly, on leverage, it's a powerful tool that allows traders to control a large amount of assets that is with relatively small amount of capital. So this means that you make a potential large profit from small investment. However, it is important, to remember that leverage also increases your potential losses. So with the potential of profit is greater, so is the potential of losses. So let me give you an example. What do we mean by leverage here? For example, let's say you want to buy a futures contract for FKLI, but you only have 4,000 or 5,000 to invest. Now, let's say currently FKLI is at 1,006, so multiply per point is actually $50. So one contract of FKLI is actually worth 80,000 ringgit. So trading futures, you don't have to pay for the full amount, 80,000. With leverage, with just only the initial margin, which is currently 4,000, you might be able to control 80,000 worth of FKLI. So here you can see that with your initial deposit required, it's just only 5% of the total contract value. Now let's say the general market is up by 1%, which is 1% of 1,006 is 16 points. So if you use 80,000 dollars to invest in a well-diversified portfolio that tracks the FBMKLCI index. So your stock portfolio will follow the general market up by 1%, for example. However, if you are in the futures market, one FKLI contract that tracks the overall market, 1% up is 16 points, right? So 16 points times $50 per point, that is also equivalent to $800 in return. But because you're using $4,000 to take a position in the general market, so for 8,000 divided by 4,000 of your capital, 800 profit divided by 4,000 of your capital, your return is actually 20%. So comparing investing using the full amount of 80,000 using futures contract can actually magnify your return because you have leverage. Now, another example on FCPO. Let's say you want to buy a futures contract for FCPO, but you only have 7,000 to invest. So let's say currently FCPO is at 4,000 and multiply per point is $25. So one contract is worth 100,000. And trading futures, FCPO, you don't have to come up with 100,000. With leverage, you just need to have fulfill the initial margin requirement, which is 7,000. So let's assume that the FCPO price goes up by 2%, and that is actually equivalent to 80 points. So if you use a full 100,000 to invest in the crude palm oil, your return is just only 2%. However, if you are in the futures market, 1%, which is 2%, which is 80 points times $25 per point, that is $2,000 of profit. So 2,000 profit divided by 7,000 capital, so your return is actually 28.6%. That is pretty huge, comparing investing using the full amount of 100,000. So here you can see using futures contract can indeed magnify your return because you have this leverage. You don't have to come up with the full amount, but just only a fraction amount of the money to make this kind of return. Now, the fourth benefit, of course, it's hedging. It's a good way to reduce the risk of losses by offsetting them with another investment. Now, in other words, hedging is like buying an insurance. In futures trading, hedging is actually done by taking the opposite position to your existing investment. So for instance, if you own a stock of a portfolio of stocks, so which means you're actually buying your stocks, and you think that you may experiencing a stock market downturn, so you can actually hedge your portfolio by selling futures contract to hedge against your portfolio. So if the stock market is down, so theoretically speaking, your stock portfolio will be coming down and you will be experiencing losses. However, if you also have a futures contract in a short position, you will be making some profit in shorting futures. So this, if you net it up, your losses might be lesser overall in the market. So this, as retail traders, you can actually use futures contract to hedge against potential losses. And another section on hedging, this might not be relevant to you as a retail trader, but this is a hedging for those who are in the commodities market, especially those commodity producers and commodity users or buyers. So but however, anyway, if you understand this, you definitely would have a broader overview of how the market dynamic actually works. So let me give you an example of hedging. Is that in case of the CPO refinery companies. Refinery companies are actually those who actually buy CPO. So all you need to look at is actually this buying position. So for CPO refinery companies, they can actually buy CPO futures to protect themselves from a price increase in the future. So this way they are able to lock in at a price for their CPO cost and avoid potential losses in case the price rises. And this, of course, on the other hand, this applies to CPO producers as well, because they can also use futures contract to hedge against price coming down to manage their risk. So in short, all you need to do as retail traders is that you can actually use index futures, FKLI, to hedge potential losses in your stock portfolio and protect yourself from market volatility. Later on, I'm going to explain a little more on that. And lastly, on diversification, it's a good strategy which involves spreading your investment across different assets and markets to reduce your risk. By investing in a variety of assets, you are actually less exposed to any one asset performance, and you are also able to better position yourself to in terms of any downturns. And futures trading can in fact be a very useful tool to diversify, because it allows you to invest in a wide range of assets, such as commodities, futures, and even stock indices, all in one place. So let's say if you are investing in the stock market, you diversify your stock portfolio by having different companies, different sectors, and different industry. However, you need to realize that no matter how well you diversify in the stock market, all of them still falls under the same asset classes, under the same category of product. For example, let's say if you have a portfolio of stocks and bonds, while these are actually common, investments, they are both affected by different factors and can be volatile in different ways. So all you can do is, by adding futures contract such as, commodities like gold, crude palm oil, you can actually diversify your portfolio and reduce your overall risk, because commodities and currencies, they tend to have a different market fundamentals, different fundamental drivers that affect the price movements. So in fact, in short, all you can know is that, having futures contract added into your portfolio, because futures, they have different assets and markets that you can use or even utilize to have a good diversification. So now that you have already understand the basics of features of futures contract, so now let's compare futures with different types of trading instruments in the market, so that you are able to see the uniqueness of futures trading. So here I'm going to compare between futures and other popular trading instruments. So in the next few slides, we are going to compare futures with stocks, futures with options and warrants, and futures with ETFs. Now let's begin with futures with stocks first. Let's have a look. Now, of course, if you let's look at stock as an asset first. Stock, if you were investing in stocks, you need to understand that each and every stock, it has a stock specific risk. Now, of course, this sound might be new to you. It's a jargon in finance, but what does this mean is that it's a risk unique to that particular company. Right, so it can be including the company performance, the management, the product, or even the financial strength. Stocks also has industry specific risk, a risk that is unique to that particular industry. So such as there are regulatory or even economic cycles. Now, I believe all of you are Malaysians. Malaysians, as we are aware that recently we have a reduction in diesel subsidy. Am I right? So reduction in diesel subsidy means your diesel price might be increasing. So these can definitely have a significant impact for those local industry that are highly rely on diesel in their business operation, such as those logistics and transportation industry. So this is industry specific risk that there are some when there are something that is changes in the industry, it might actually impact towards the stocks or the industry that you invest in. One thing about stock is that if you want to have leverage in stock, then you need to have margin trading. So which means you need to buy stocks on margin. In other words, to make it simple, is that you need to borrow money from your stockbroking company or investment bank to do margin trading. Of course, if you do margin trading, it means you will need to pay interest for the borrowing. All right. Now, and lastly, on stocks is that sometimes stock market, definitely you have lack of flexibility in taking short position. Now, what this means is that not all stocks allows short selling, and if you want to short sell stocks, through regulated short selling, you still need to go through security borrowing and lending process, and then maybe if you are able to borrow stocks. There may be interest charges in borrowing stocks for you to short. And one limitations is that if you even if you can borrow stocks to short, however, the quantity that you are able to borrow might be limited. So for example, let's say you have intention to short let's say 500,000 shares of a company A, but you are only able to borrow, let's say 50,000 shares to short only. So here you can see it's a limitation on that. And yes, in Malaysia market, you're able to do IDSS, which means the intraday short selling. But yes, you can do short selling, but it's just only within a day. But you have to cover your position at the end of the day. So you can't hold your short positions for medium to longer term. And of course, for stock price to go up, there is only one way, which means if the general market expect the stock price to have positive expectation, or if the sentiment is good, then only stock price is only able to go up. However, for futures market, you can see here I'm going to highlight several benefits here. Is that in futures market there is no stock or industry specific risk, because for example, if you are trading or investing in index futures like the FKLI, FM70 and F4GM, these are index futures. What it means is that they are actually an index that is representing a basket of stocks. So which means this basket of stocks comes from there are a lot of stocks. For example, FKLI, you have the top 30 market capitalization stocks that is coming from different industries. So it is, originally by default, it's already well diversified. So you don't have to bother about stock specific risk or industry specific risk. Because futures contract, it's a leverage product itself, as I've already shared with you in earlier slides in topic 1. So you don't need to do any borrowing, and you can directly take a short position in the market as long as you fulfill the initial margin requirement to take both long and short position. And definitely futures contract, you have a very high flexibility in shorting positions. You don't need to borrow anything. You can immediately short in the market directly. So as you already know, futures, you can do both bi-directional trading in both directions. Now here we want to compare options and warrants versus futures. Now, of course, I'm not speaking about individual stock options or stock warrants because those are not comparable, right? So here we want to compare index options or index warrants versus index futures so that they have a both fair apple to apple comparison. Now, for those of you who may have a little bit knowledge in warrants, just a quick I want to highlight, if you are investing in warrants or trading options, here are several factors that you need to take into consideration about, because your option pricing, it's mainly affected by five main factors, but there are three factors that you actually really need to look at, like your strike price, your expiry date, as well as the implied volatility. And challenges is that most of the options and warrants are, is the market maker who provides the liquidity for you to enter and exit the market. So, which is why the liquidity can tend to be low depending on who is the market maker. Now, there are a lot of complications. Let me show you how is that complicated, because for example, let's say currently if you're bullish with the Malaysia market, right? So you buy an index option or index warrant at 1006 level. So when index is at 1006, you buy an index warrant or index options. Let's say your warrant costs you 1 ringgit. So 2 weeks later, let's say the index may go up and then fall back to the same level, 1006. So one thing you need to know is that your option value, the pricing can be actually lower. For example, 95 cents, because your entry price is $1. But 2 weeks later, even though the index has no changes, right? But your option value would be lower. Why? Because the value actually goes down due to time decay of your options or warrants. But for trading futures, the pricings are very direct and easy to understand. Even though you buy futures at 1006, 2 weeks later the market fluctuates and futures goes back to 1006. In fact, your futures, your profit and loss is actually still equals to zero. So you can see futures trading, the pricing mechanism, it's very, very simple and direct, and the liquidity would be high for you to enter and exit. And lastly, ETFs versus futures. Of course, ETFs is like a basket of stocks, similar to like a mutual funds. And for ETFs, they are a little bit special because they track a particular index. So because ETFs, they are investing into index of stocks also, so they are still subject to stock specific and industry specific risk. But of course, they are a little bit more diversified in terms of a basket of stocks. It's ETFs, of course, it's lower cost compared to mutual fund, because ETFs, they also have a management fee, which is what we call as the expense ratio. Of course, the management fee, it's a little bit lower than mutual funds. Generally speaking, ETFs has fair liquidity. However, because they are tracking a particular index, so they might have some tracking errors. So which means tracking error means that they may not perfectly track the particular index that they are targeting to track. So which is why sometimes you see ETFs, the pricing for ETFs, they might be selling discount or selling premium towards their net tangible assets. So this is the perks for ETF. However, for futures trading, again, they have no stock or industry specific risk because they are directly linked towards an index. You have minimal tracking errors because, as you know, futures is a derivative, so which means they are derived from the underlying assets. So it follows for example, if you're trading FKLI, it would definitely follows FBM KLCI very closely. And futures, they have no management fee at all, and it has a higher liquidity. Now, let me show you a comparison by a study conducted by the CME group, the Chicago Mercantile Exchange Group, is that they, as you know, in the US market, they have a lot of futures uh, contract as well as a lot of ETFs, right? So here, what I want to highlight to you is that you can look at this top two section is that they are E-mini S&P 500 futures versus their SPY, which is their ETFs market for S&P 500. So here you can see that the trading volume for futures is actually relatively higher than the trading volume for ETFs itself. It is actually the uh, E-mini S&P futures, it has 9.8 times more than the ETF's volume overall. So here the second one is actually the E-mini S&P futures versus another ETFs global, which is still higher ratio, which means generally speaking, futures, what we can conclude here is that futures market, the trading volume is actually way higher than the general ETFs for many futures contract. So it's actually a good thing, that this is one of the benefits for futures contract if you don't already know. All right. So now that you already know what are the advantages of futures contract, let me share with you on the diversification. Now, this topic is very important. So besides doing diversification in the stock market, you can actually use futures contract to diversify further also. So here I'm going to briefly discuss the concept of diversification and why it is important for you to diversify, how you can use futures contract to do so. Now, of course, I want to skip a little bit on the diversification. All you need to know is that diversification, you need to have different various assets so that you can, reduce your exposure to one single asset. So in short, if your single asset, if you just only invest in stock market itself, all of it is actually under one asset class. So which is why if, a general market stock market is actually sentiment is actually down, your whole portfolio would generally would be dragged down as well. So which is why you want to diversify your whole portfolio, put a little bit portion of your portfolio into some other form of asset. Now there is a question for you to exercise a little bit your mind, right? Can you let me know which of these portfolio is more diversified? Now there are two portfolio here. Now there is one portfolio A here is that, let's say this portfolio A, it is very well diversified with 10 stocks. Okay, all of these 10 stocks are index linked. 100% of the portfolio is actually in these 10 numbers of stocks. Another portfolio is that same thing. The stocks that they invest, they also invest in 10 stocks. However, they only invest 80% in these stocks, and then 20% of the portion of the money is actually putting into futures trading. Now, my question to you is that which portfolio is better diversified? Is it portfolio A or portfolio B? Can you let me know in the chat box which of these portfolio has a better diversification? Can you type in the chat box? If you think portfolio A is more diversified, you can type in A in the chat box. If you believe portfolio B has better diversification, you can type in B in the chat box. All right, I see majority of you type in B, right? Okay, so in fact the answer is, theoretically speaking, yes, portfolio B seems to have a little bit more diversified. But the answer is, it depends on what futures contract you add into your portfolio. Of course, here there is a little bit insufficient information to conclude whether portfolio B is well diversified yet. But let me give you a little bit more information in the next few slides. So why there is a benefits of diversification here is that firstly, it reduces your risk, because if your one asset they are performing very poorly, so let's say if your whole stock portfolio is performing poorly, at least your another asset is actually has a good performance, or at least it is not affected overall. So when you look at your whole overall, these two things added together, right, at least it does not have a significant drawdown. Secondly is that your returns would be a little bit smoother because you will be definitely experience lesser volatility, and your return would be more stable over time. And lastly, when you have a portfolio, you will be protected against market fluctuations because different assets will react very differently according to market conditions. Because if, let's say, stock market is down, at least for example, if you have assets in commodities or other asset classes, they may not be affected, or they might have inverse relationship, which means if stock market down, the other assets are actually going up. So which means on overall, your overall portfolio has less negative impact, or at least one side is making money. When when those assets is making money, you can sell those asset off, and then take those money, put in back in your stock portfolio. So these are the things that you can actually play around to manage your portfolio. Now here I want to share with you a brief technique on diversification, because a lot of people think that diversification means the more assets, the more stocks you buy, the better it is. In fact, sometimes we need to ask question ourselves, is that how much money we can buy, right? We can't buy the whole market. So which is why there is something, when you do diversification, there is one thing that you need to take into consideration about, is the correlation. Now, what do I mean by correlation is that when we look at correlation, their correlation figure starts from 0 to +1 or 0 to -1. So these are correlation numbers. From, let's say, let me show you here, is that we have high correlation category, moderate correlation, and low correlation. Of course, they are positive and negative correlation. Now, let me explain to you what is a positive correlation here first. So if you have high and positive correlation, so which means generally, if you put all of your stock investment in just stocks only, okay, no matter, it doesn't really matter how well you diversify. All of it may be considered, if your asset is just only in stocks, all of them can be considered as high correlation. So in order, let's say if the general market is actually down, right, you will have a very close impact. The higher correlation means you have your portfolio would be following the market very closely. So if you want to have a diversification, means that you want to make sure that your portfolio overall has a moderate, or even best, has lower correlation. So which means if your let's say in the earlier example just now, if you have 80% in stocks, so which means you have let me draw here. If you have 80% 80% weightage on stocks here, and then let's say you have 20% weightage in your futures here. So which means you may be able, bring your overall portfolio correlation to moderate correlation. So here you can see this is the way how you are able to create the diversification without actually trying to buy too many things, or trying to trade too many things in the market. So simply speaking is that we can see is that generally your stock portfolio would be under this category. So if you want to bring down your overall stock portfolio to have lower correlation, right? So what you need to do is that you want to invest in assets that have at least the lower correlation. The lower the better. Or you can bring your invest in assets that have a negative correlation, so that your overall portfolio correlation can be lower. All right. So simply speaking, if you want to achieve overall portfolio diversification, you want to make sure that the assets that you add into your portfolio has low correlation. Then this is where your portfolio can be well diversified. Now let me share with you several examples here. Now, one of the example is that let's say we have FBM KLCI. This represents your stock portfolio, and you add another asset which is FCPO, and this represents a commodity portfolio. So let's have a look at both of these comparing their price movements across the same time. So here you can see if I put green arrow, which means you have opportunity to trade, you'll be maybe making money. The next period is that your stock is actually coming down, which means your stock portfolio is coming down. But for uh, commodity futures here, you can still take advantage of taking a short position and make money from here. Stock portfolio going sideways, your stock may not be making money, but if you have commodity in your portfolio, you maybe take advantage on for an uptrend. Here you can make money as well. So you can see each of the same comparable period whereby if you were to add FCPO into your portfolio, you are able to have an additional return somewhere else. Okay, and this chart is actually before COVID. Now let's see how about after COVID, whether there is any opportunity or not. Similarly, for the similar period, even though commodity is actually down, and then for stock market, during COVID there might be a bounce, and after that the stock market actually goes quite a period of sideways, about 1.5 years. But here is something interesting is that you can see that in FCPO it experienced actually considered quite a very bull market in the commodities market, which in fact there are a lot of trading opportunities by just only taking one side of a long position. Right, so here we can sum up is that if you were just add FCPO into your portfolio only, you can have overall enhance your overall return while at the same time lower down your overall portfolio risk. Now here is an asset class correlation table which I've shared with you earlier on. Now there are a lot of things that in the table, but here I'm going to highlight which of the things that you need to take into consideration. All right. So here we can see I have put down this blue color line is that commodity markets compared with some other assets. So this is commodity comparing with investment grade bonds, commodity compared with your cash market, commodity compared with currency markets, commodity comparing with this one, your S&P 500, which is 0.4. Of course, in Malaysia, we do not have so many asset classes, right? I take an US market as a case study so that you are able to see how does the interaction of other asset classes compared to stock market. So you can see for commodity asset alone, your correlation here compared with the stock market is actually quite moderate correlation, which is 0.4. All right, 0.4, which the table just now that I show you is actually here. You can see 0.4 considered as moderate correlation, which is actually a good thing. Another asset class that I would like to highlight to you, which is managed futures. So of course, Malaysia may not have managed futures. Now, managed futures, what it means is that it's like I believe you understand what is called mutual fund, right? So mutual fund generally invest in stock market. So managed futures is like another mutual fund, but these kind of funds, they just only focus in futures market. They don't invest in stocks. They don't invest in bonds. All they invest is actually just only in futures contracts. So as you know, in US futures, they have not just only index futures, they have currency futures, agriculture commodity futures, they have energy futures, all sorts of, even they have bond futures. So you can see they just only trade futures itself only, they don't trade any other assets. So you can see that for managed futures, they have a very, very low correlation compared to all other asset class. It's actually way below 0.4. It classifies as you can see here is a low correlation here, right, on the category here. So it's all below 0 or below 0.4 or even at the negative correlation. So sometimes you can see people saying that managed futures is actually considered quite a market neutral strategy. So which is why as Malaysia, in Malaysia, we are quite fortunate is that we have several popular futures product like our FKLI, FCPO that we can actually, if you do not want to invest overseas, just only Malaysia itself can actually create quite a good diversification. All right. Now, this is just a ranking from negative to very highly positive correlation for stock market, US stock market compared to other asset classes. So here is a ranking from low correlation to high correlation. It's easier for you to have a comparison. So let me highlight a few assets class for you, which is the currency, the managed futures, as well as commodities. So you can see these three asset class, it's having a very low correlation or even negative correlation. Of course, ignore this, all of this percentage, because correlation is not supposed to have a percentage, because I think the person who published this may have a error here, right? So correlation, as long as it is close to zero or even negative, it's something good for your portfolio to diversify your portfolio to have a low correlation. All right. So later on, I'm going to share with you what are the things that you can do to create a low diversification. So simply speaking is that using futures, you can actually gain exposure to broad range of assets. For example, using index futures in Malaysia, we have several products, which is your FKLI, FM70, and F4GM in index futures. You can also use commodity futures, such as we have crude palm oil futures, gold futures, and the recent launch futures, which is your DCE soybean oil futures, and also currency futures. We have the FCNH. So you can see Malaysia itself has a very good opportunity for you to diversify your portfolio. All right, so now that I have already gone through a lot of the foundational stuff, now there are 6 unique trading ideas using a Malaysia futures contract that I would like to share with you. Now, the first trading idea is that if you are not sure what to buy when the market is going up, you can consider actually take a long index futures position to participate to participate along the market and move together with the market. Now, of course, I believe those of you who are currently active in the stock market, you might already know is that recently Malaysia experiencing consider quite a minor bull, right? Can you share with me whether you experience a similar thing? Is that the market is going up, however you're not quite sure what to buy in the market. You are still actually still searching what are the good stocks to buy, and sometimes you might be experiencing that the stock that you buy it might not even follow the market. If you experience this thing, you can type in I in the market, so that at least this is actually one of the strategy that you can utilize. Now, why is that so? Is because for those of you who just only doing in stocks, as I've already mentioned, stocks has individual stock specific and industry specific risk. It can be very time constraining if you were to analyze stocks, because there are over 1,000 counters. Even with stock screener, it can be still difficult for you to capture the whole market of selecting the best stock to trade. However, if in case if in the near future, if you do not know what to trade, this is where while at the same time you want to participate with the uptrend in the market, you can actually consider this strategy. Take a long position in index futures. You have FKLI, FM70, and F4GM, which is actually index futures that tracks the whole market. So index futures, they don't have stock specific or industry specific risk. It's easier for you to just have an exposure with the market, because you don't have to analyze individual stocks, and very fast by just getting involved in the index futures, you already have easy exposure towards the market. Okay, so how many of you actually like this trading idea? Number one, if you like this idea, can you type in one in the chat box, so that I know this is actually one of the idea you maybe potentially put into your strategy list in the future to trade the futures market. If you like this idea, you can type in a 1 in the chat box. All right. So in fact, do you know that this is actually one of the very popular strategy that is commonly used by hedge funds, and this popular strategy is also used by managed futures funds. So, which is why I've already mentioned futures trading itself it's already unique. So hedge funds or managed futures funds, they call this strategy as the global macro strategy. Okay, if you're interested, you can actually Google search about it, what is called by a global macro strategy. What it means is that it actually get into the index futures to get involved with the general by tracking with the market. Now, second trading idea is that when the market is coming down, if you're not sure what to sell, you can actually take consideration about shorting the index futures, because you don't have to borrow. Why? Because in stocks, I have already sometimes if you believe that I believe some of you invest in stocks, right? Especially if your strategy is investing or trading undervalued stocks, and occasionally you might be afraid that sometimes when the general market comes down, very funnily that your undervalued stocks might not go down with the market, but in fact sometimes your undervalued stock might go up when the whole general market is coming down. So sometimes you might want to hold your stocks, or so, which is why you might be afraid that the market comes down, but you still want to hold your stock. So in fact, you can still hold your stock while at the same time short index futures. So you treat this as a separate trading strategy that you can add into your portfolio. How you can do that? Again, you can take a short position with the index futures, because as I've already mentioned, you can the profits that you get from futures can actually be reinvested in your stock if you like stock market so much. Okay, again, this trading idea number 2, it's also like trading number 1. It's a global macro strategy. You can gain direct exposure to the general market. So it's a wonderful strategy that you can take into consideration. Now, trading idea number 3 is that in futures market, as I've already mentioned, the liquidity is actually still very high, even though during downtrends. At least the liquidity is not as low as stock market. Now, for those of you who those of you who have gone through market downtrend before, especially those who have a little bit more experience in stocks, where you may experience during COVID time, when you're still holding stocks during COVID breakout that time. So that time, during a very strong downtrend, a very negative sentiment at that particular point in time, you may experiencing that you want to get out of stock. It's very, very difficult. Why? Because nobody is willing to buy stocks. People are fearful of the market. So, which is why when you want to get out of your stocks in a negative sentiment or a strong downtrend, it's very, very difficult. You need to sell at a very unfavorable price. So, in order for you to get out, you can actually take into consideration by shorting index futures. So I've already mentioned, index futures or futures product itself, not just you can just only trading outright. You can also use futures as an approach for you to hedge against your portfolio. So in case you cannot sell your stocks quickly, at least you take a short position in the index futures by hedging against your portfolio. So portfolio value comes down, your futures value is portfolio is actually goes up. So at least one side positive can net off the other side negative. All right. So this is actually one of a pretty good trading idea that you can take into consideration, using futures contract to hedge your portfolio during a downtrend. Now, trading idea number 4 is that futures market itself has leverage for you to amplify your return, as I've already shared with you in topic number 1. Why? Because if you want leverage in stocks, you need to involve in margin trading, which means borrowing money from your stockbroking firm or borrowing money from the investment bank. So there are costs of borrowing, because if you want to borrow money to from the banks uh, to increase your capital or buying power to trade, there are a lot of borrowing costs, which means you need to pay for interest, higher brokerage fee, and as well as other costs if you want other leverage products such as trading index warrants or index options, because this one, the cost is also high due to time decay. However, a futures contract, as I've shared with you, it's easier for you because futures market, you don't have to consider about cost, because you don't need to pay interest to get leverage. You don't need to worry about other costs, because your futures contract itself is a leverage product. It goes by contract specification and it has lower trading costs. You just need to come up with a fraction of money, which is fulfilling the initial margin requirement as a deposit to open a futures contract. Now, trading idea number 5. If you add a futures product into your portfolio, you can actually reduce risk and create a good diversification for your overall portfolio by just only using index futures. Now, if as you already know, stocks, you can only make money when price is going up. So there are a lot of factors that you need to consideration when you invest in stocks, because especially on the fundamental part, which is what we call it as the stock specific risk and industry specific risk. You need to look at the earnings, the management of the company, the industry, economy policy, whether it impacts the particular industry that you're investing or not. So there are a lot of things to consider. Now, well, generally speaking, if stocks you can only making one direction, you can actually add futures into your portfolio as well, because futures you don't have to worry factors that is affecting stocks. Okay, if there is ETFs for you to invest in Malaysia, that's good. If there is no ETFs, you can actually take index futures into consideration as an additional product, as another product that can give you a pretty good diversification. All right. So in Bursa Malaysia, we have FKLI, FM70, and F4GM as an index futures. Because all you need to concern by investing index futures is the global, the macroeconomic factor as well as the global factor. These are the two things that you need to take into consideration. You don't have to go into those micro factors like those fundamental factors that is related to the individual stocks itself. Okay, by the way, just for your to highlight another benefits, you can trade both directions in the futures market. All right, and now lastly is the trading idea number 6, which can help you to diversify even further, which is different asset classes can create greater diversification benefits. Now in stock markets, you know that there are limitations in diversification, no matter how well you diversify across different industries, different stocks. However, all of these stocks still falls under the same asset classes, because even with the company that you invest in with a strong earning, but if the market sentiment is weak, your stock may not be performing well. So which is why we want to have other asset classes that is totally has completely different fundamental drivers compared to the stock market. So which is why you can consider diversify using futures market. So number 1 you can do is actually you can use index futures to hedge your portfolio when the general market is down, because index futures are highly correlated to stock market. So index futures is a good thing as a global macro strategy, or as a hedging. Another thing is which is on the correlation that I shared with you earlier. So correlation means the relationship or the connection between the assets. So earlier I've shared with you with data is that the commodity assets, it has lower correlation against with the stock market. It has moderate to low correlation. So it's a good thing for you to take into consideration by adding commodity futures. We have FCPO, FEPO, FGLD, and also FSOI, which is classified under commodity futures. We also have currency futures, which is the F, C, and H. So these two asset class is, I would say it's actually considered as a different asset class. It's a very good example that you can add into your diversification. All right. So hopefully you have briefly a clear idea how these 6 trading ideas that you can take into consideration in adding into your trading strategy. Because I believe when you learn fundamental analysis, when you learn technical analysis, probably you may not learn about portfolio management strategies, right? So these 6 trading ideas are actually one of I would consider this as portfolio management strategies. In other words, it's also an additional playbook that you can add into your trading strategies just only in the Malaysian market itself. All right, so there you have it. Let me summarize the 3 main key takeaways. As you know that Malaysia futures market has a lot of advantages and benefits you can unlock using these 6 unique trading ideas as your trading strategies. And in order to diversify, you don't have to look further. Malaysia itself, you can have a pretty good diversification by adding local relation assets, which is depending on how you utilize the index futures. And definitely the commodity futures, it has a local relation that you can take into consideration to add into your portfolio as well. And you can take a snapshot of this slide that on this these 6 unique trading ideas. It's very important that take into consideration how you can design your own trading plan to utilize some of these 6 trading ideas to craft up with some other strategies to diversify your overall portfolio. Okay, so that's it that I would like to share. And this is that sometimes when it comes to trading psychology, it actually started with having a right education and knowledge, so that when your knowledge is right, when your education is correct, a lot of trading psychology issue can be solved. Because when your knowledge is right, only you have chances to apply it correctly with the right knowledge. Okay, so that's it. I pass this back to Ting Ting.